down, sleep.
So is alpha dead?
No, alpha is rare and it's expensive. So it makes it hard for a large institutional investor to harvest, I think that's what I would say.
It's expensive. Tell me a little bit more about.
Well, a lot of the gross alpha goes to the manufacturer of the alpha, and the investor is faced with a smaller proportion of the juice, so to speak.
Now the expensive part, it was very interesting, right? A lot of the alpha goes to the money manager because of high fees. Is there a way to change that dynamic? I mean, the investor, right? You are the client.
Well, I think that the brilliant alpha generators also have the world's best marketers. So they frame the proposition in a way that I think prevents investors from really seeing what the true proposition is. In Wisconsin, we focus very, very heavily on the split of the gross alpha or the gross juice between the producer of the alpha and the provider of the capital.
Well, talk a little bit about your process and how you go about it in Wisconsin.
Well, we believe that alpha is a zero-sum game.
Okay.
So we start with the belief when we look at a producer of alpha that the null hypothesis is that they have no skill and that there is no alpha. And then we try to prove ourselves wrong. So we will tease out the cash return, the market return, what we call exotic beta, and then we'll look at what's left as the real skill-based alpha. And then we look to keep a certain percentage of that depending on how difficult we think it is to produce. But at the end of the day, we always want to keep more than half. We find that a lot of what is being promoted or framed as alpha is just beta in fancy dress. So by the time we get to the pure alpha and we get to the split, we actually find very many providers that make it through our screen.
Give me an example of that. It's an interesting concept. Yeah, walk me through one.
Well, we take a hedge fund. So we start by subtracting cash because we don't want to pay anything for cash. Get no credit for that. What's left, we then try to separate into the market exposure. So let's say we have a market neutral fund or a long short fund and they're long equities, net long equities. We can produce an equity beta in-house at almost no cost. So we don't give them any credit for the equity beta. And then we kind of look at their style, their HFRI style return. So the return for that segment of the hedge fund industry, and we see what their correlation is to that. We call that the exotic beta. Okay. We give them very little credit for that. We don't want to pay for that either. Again, we manage over half the assets in-house, so we can produce that ourselves.
Right, you're in a different position.
So you're left with kind of what's unique, what's unusual, and that's what we really want to split with the manager. And many times after you've gone through that, the manager is keeping 75, 80, 90%.
That high.
Of the real alpha. Now, we know we're estimating we're making errors, but it's a matter of making the right error, right? So we'd rather be stingy and stubborn and narrow-minded and not pay for something that's not really there, as opposed to walking away from a good manager that maybe we really should hire. So we're accepting an outcome that maybe isn't the right outcome because we're just very, very focused on making sure the split is in our favor.